Have you ever been in a situation where it feels like you analyzed the market perfectly, entered a trade with confidence, and then got stopped out almost immediately without understanding what you missed? In most cases, traders make the exact same mistake. They fail to consider the bigger picture across multiple timeframes. As a result, they enter trades that go against the overall market direction. Welcome to Graph Insight. In this video, I'm going to show you how to solve that problem using top-down analysis. We'll break down how to apply this approach properly no matter what trading strategy or style you prefer. And if you find this topic useful, make sure to like the video and subscribe to the channel. Now let's get started. First, let's understand what top-down analysis actually is. Top-down analysis is a trading approach based on one simple idea. You start your analysis from the higher timeframes and gradually work your way down to the timeframe you plan to use for execution. Now, analyzing every single timeframe would obviously be impractical. So for simplicity, traders usually divide timeframes into three categories: higher timeframes, medium timeframes, and lower timeframes. That reduces the entire process down to just three key timeframes to analyze. It's also important to understand that this classification is not fixed. Because of the fractal nature of the market, there are no strict rules here. It all depends on your trading style. For example, a day trader might use the daily, 1 hour, and 5-minute timeframes as their higher, medium, and lower timeframes, whereas a scalper might use the 4-hour, 15-minute, and 1-minute charts instead. By fractality, we mean that the market follows similar structural principles across different timeframes. In other words, the same price behavior can repeat on both higher and lower timeframes. And that is exactly why top-down analysis is so effective. So instead of analyzing every timeframe available, we will focus on just three, one from each category. And it's important to understand that each of these timeframes has a different role. The higher timeframe is used to identify the overall market direction and key context. The medium timeframe helps us find a valid trade setup within that context. And the lower timeframe is used for precise execution. Now let's go through a step-by-step example of how to apply top-down analysis properly. In this example, I'll be using the daily, 1 hour, and 5-minute timeframes. But again, there are no strict rules here. Everything depends on the trading style you prefer. But before we continue, I want to mention that I also share daily market updates and trade ideas in my Telegram channel. The link is in the description. So let's start with the higher time frame, which in this case is the daily chart. The first step is to determine market structure by marking the most recent breaks of structure and changes of character. And as we can see in this example, the market structure is bullish, which tells us that the overall direction of the market is up. The second step is to identify strong levels on the chart so we can understand where price is most likely to move next. To do that, we begin by marking the swing high and swing low of the most recent price leg. Since the market structure is bullish, we know that the most likely target for price is the swing high. A break above that high would confirm a break of structure and continuation of the bullish trend. However, we still don't know where the pullback may end before price continues higher, which is exactly what we need for a potential long entry. So in this case, we look for the nearest level that could act as support. And here we can see a bullish fair value gap. Price has already mitigated that imbalance, which means there is a strong probability that it may react from this level and continue moving toward the swing high. This kind of level analysis gives us market context and helps us understand where price is most likely to move in the near future, which makes it much easier to find a precise entry later on. At this point, the higher time frame analysis is complete because we've already identified the bullish bias in the key area of interest. It's also important to understand that the level we are looking for does not have to be a fair value gap. It can be any significant level capable of producing the reaction we expect: swing highs and swing lows, order blocks, breaker blocks, and so on. And that is what makes top-down analysis so universal, because it can be combined with almost any trading strategy. Now let's move to the medium time frame, which in this case is the 1-hour chart. The goal here is no longer just to define direction, but to find a trade setup that aligns with the higher time frame bias. To do that, we go through the same basic steps we used on the higher time frame. First, we analyze market structure again by marking breaks of structure and changes of character. In this example, we can see that price first formed a local bearish break of structure, then performed a liquidity sweep, and after that formed a bullish change of character. For us, this is an important confirmation that the fair value gap we marked on the higher time frame has been respected, and that price is starting to react in line with the overall bullish bias. The second step is to identify another important level that may act as support and potentially be used for a long entry. And here, we can see a bullish fair value gap on the 1-hour chart. We can also see that price has already mitigated this FVG, which increases the probability of a continuation to the upside within the broader bullish trend. At this point, the medium time frame analysis is complete. Technically, we could already enter a long position here, but instead we go one step lower, because the goal of the lower time frame is to help us find a more precise entry, which can give us a much better risk-to-reward ratio than entering right now. So now we move to the lower time frame, which in this case is the 5-minute chart. At this stage, we can still see a local bearish trend on the lower time frame, so we need to wait for confirmation that the short-term direction is shifting back to bullish before looking for an entry. Then we can observe price forming a bullish change of character. On top of that, during the latest price leg, a bullish fair value gap is created, and that becomes our ideal area of interest for entry. As soon as price returns into that FVG, we can look to enter a long position. The most common execution model traders use in this situation is placing the stop loss slightly below the fair value gap and setting the take profit at 3 times the risk distance, giving us a 1-to-3 risk-to-reward ratio. And while this is a very rational approach, it is not the only way to execute the trade. For example, we could use the previous swing high on the 5-minute chart as our take profit, which would turn this into a shorter-term trade. But we could also move up to a higher time frame and place the take profit at the previous swing high from the 1-hour chart. That trade would naturally take more time to play out, but in return it offers a larger profit potential if we are patient enough. And the same logic can be applied to the daily chart as well, by targeting the previous swing high from the higher time frame perspective. So there are many possible ways to execute a trade, but these are some of the most rational options as long as proper risk management is in place. Now, besides the approach we've already covered, there is another extremely important use case for top-down analysis: identifying potential trend reversals early. For example, on this daily chart, we can clearly see a bullish trend, and we can also see price reaching the liquidity resting above the previous swing high. But even at that point, we still do not know whether price will perform a liquidity run and continue higher, or a liquidity sweep followed by a reversal. And this is exactly where top-down analysis becomes so valuable. The next step is to zoom into that most recent daily leg on the 1-hour chart so we can understand what kind of structure is forming on the lower time frame. On the 1-hour chart, we can first see several consecutive bullish breaks of structure. After that, price forms a pullback and attempts to print another bullish break of structure, but instead runs into resistance in the form of a bearish fair value gap created during the pullback. As a result, price rejects lower and forms a bearish change of character, suggesting that order flow on the 1-hour chart may be shifting from bullish to bearish. To strengthen that idea, we can then drop down to the 5-minute chart and look for additional confirmation in the market structure there. And on the 5-minute chart, we again see an initially bullish structure with multiple bullish breaks of structure. But then price forms a change of character followed by a bearish break of structure, giving us additional confirmation that bearish momentum is starting to take control. So in summary, when it comes to identifying reversals, the lower timeframes often reveal the earliest signs of structural weakness, and that can help you stay one step ahead of the market and avoid getting caught in liquidity traps. Thank you for watching. If this breakdown helped you see the market more clearly, make sure to like the video and subscribe to Graph Insight. Let me know in the comments which concept you want me to break down next. I'll see you in the next video.